Okay, so I'm Todd Villarubia. I'm the senior partner at the Wealth Planning Law Group. I want to thank everybody for coming today. As I mentioned earlier, we're actually going to be audio taping this for a webinar. So for all the people across the world on the internet that are listening to this, we welcome you as well. We're going to be talking today a little bit about these Delaware Asset Protection Trusts. As some of y'all have heard me speak about this before, we have a lot of problems, quite frankly, with Louisiana-based trusts. Basically, there's the Law Institute that works on revising our laws over time. And unfortunately, there's some members of the Law Institute, from what I understand, that are really, frankly, kind of against trusts in general. Louisiana didn't really adopt a trust statute. I think it was, Cheryl, you may know this, 1965, wasn't it? So, we were kind of late to the game with that. And a lot of the purists really kind of feel that the Louisiana law, the basis for which our law was founded, is really kind of at a crossroads from the concept of using trust. And I think that's part of the reason why, that our trust laws haven't been updated. And quite frankly, over the last several years, I've been talking to various members of the Law Institute that are on the committee, and trying to talk to them about what some of the other states are doing, and unfortunately, they can't really seem to get a lot of movement on it. And I've kind of gotten to a point in my career where I can't any longer in good conscience tell my clients that, Louisiana Trust is always going to be the best solution. Now, it's not to say that Louisiana trusts are awful, but there's a lot of limitations. So let me kind of go through a few of those. In Louisiana law, for example, there is a maximum duration. The technical term that we would call it is a rule against perpetuities. And what that means is that under the common law, there was this concept that you didn't want a trust just to be able to go on forever and ever, that it would take assets out of commerce, and there was just this whole theory that, trust should not be allowed to go on forever. And Louisiana very much is in compliance with that thought, that our trusts have a definite termination. It's basically 20 years beyond the youngest beneficiary that we establish. So when you hear people talk about dynasty trust, for example, we can go down several generations with a Louisiana trust, but we can't have a truly dynastic trust that goes on forever. Well, some of the more advanced, forward-thinking states have now enacted trust statutes where their trusts can actually go on forever. And there's numerous benefits to that, both in terms of asset protection planning, in terms of potentially with the estate tax or generation skipping tax planning. Under current law, for example, we can set up a trust where your kids will receive all the income from the trust, and when they pass away, their kids will succeed to them and take over the income interest, and your great-grandkids then succeed to the income interest, and it can literally go on forever in a truly dynastic trust. And under current tax law, if the trust is structured properly, the assets are not included in your kids' estate when they die, and when the grandkids die, the assets of the trust aren't included in their estate. And when you look at the numbers, we have some slides from some of the presentations that we've done. It can literally be hundreds of millions of dollars over, 4 or 5 generations with any kind of growth rate. Can't do that under Louisiana law. And keep in mind that as a Louisiana resident or a resident of any state in the United States, you have the ability to use a trust whose jurisdiction is established in a different state. Hello. So I can have a Louisiana resident set up a Delaware trust. I can have a Louisiana resident that could set up a Nevada LLC if that's what makes sense. Okay. What are some of the other issues that we face with Louisiana trusts? There's a number of them. So let's go to the issue of the principal beneficiaries. Under Louisiana law, we cannot shift a principal beneficiary's interest in the trust. So let me explain what that means. Have a client come in and they want to set up a typical ILET. They're going to move an insurance policy into a trust, and the trust is going to be for the benefit of their 3 children. Under Louisiana law, if the 3 children are the principal beneficiaries of that trust, I cannot put a provision in the trust whereby I can direct where that principal beneficiary's interest goes to when that principal beneficiary dies, unless that beneficiary dies both intestate, which means without a will, and without descendants. So I know this sounds kind of, theoretical, but let me give you a real life example of something that happened. Have a client come in, they have a federal estate tax problem. We decide we're going to move the insurance outside the estate so that it's not subject to the estate taxes when they die. Come on in, y'all, whenever y'all ready. Hey, y'all. And the client expresses to me, you know what, I love my 3 kids, but my daughter is married to this guy that we really don't like. And what I'm worried about is that if you're telling me, Todd, that my daughter could do a will, so therefore she doesn't die intestate, and she could say that I leave my interest in this trust to my husband, who my clients don't like their son-in-law, they're worried he's going to go, run off with some other gal if their daughter dies, it became a real issue for this client. So one of the problems we have under Louisiana law is with a Louisiana trust is that we can't just shift that kid's interest. We can't say, well, if my daughter dies, it's got to go to her children, and if she doesn't have any children, I want it to go back to my other 2 kids. You literally have to say the only way you can shift it is if they die both intestate and without children. So that's a fairly unique provision under Louisiana law that we don't have to face when we go out of state to set up a trust such as a Delaware trust. Yeah,
so per stirpes doesn't work?
It has nothing to do with per stirpes. It has everything to do with the inability to shift a principal interest in a trust under Louisiana law. You could say in the trust that, again, if they die, that it goes to their children, if any, and if none, back to the surviving kids. But if that person dies and they have a will, then they have not died intestate, and they can redirect their trust principal interest to their spouse or whomever they want, and there's no way that our clients can control it. Exactly. Right. So we've had some clients with, gay and lesbian couples, for example, and the parents of those people are sitting there saying, I don't want it. I want it to stay. I want the business that I'm going to transfer. I want it to stay in the bloodlines. I don't want it going to some spouse, whether they're straight or gay. Those kind of issues come up, and we can't address it under Louisiana law. Louisiana law does not provide for asset protection for a self-settled trust. So let's talk about that. There are trusts out there that we can establish that are outside of Louisiana jurisdiction where we can put assets into the trust, where the client puts the assets into the trust, and under that state's law, those assets, generally speaking, are going to be exempt from seizure by creditors. And that's fairly unique. So that's what when we talk about a domestic asset protection trust, that's really what we're talking about, is the ability. It's clear under Louisiana law that if some third party, like the parents, put assets into a trust for the kids, and they've got the appropriate provisions in the trust, what's called spendthrift provisions, it's clear that when a third party settles a trust and funds a trust, that those assets are protected from the creditors of the beneficiary. But this is a different step. This is not someone else funding the trust. This is the client themselves putting assets into a trust, and if it's established in certain states' jurisdictions, then those assets can be protected from the creditors of that client. Well, most of the financial planners and CPA, that are in this room will, can tell you that when you're younger, it's all about trying to grow your wealth. But when you get older, it's about trying to protect your wealth. So for the financial planners in the room, for example, you really should be talking, we all know, what industry is the most worried about asset protection? What job type? Doctors, exactly, right? Every doctor that I know of is extraordinarily, like almost hyper, sensitive to asset protection issues. And why? Well, under Louisiana law, there's actually a medical malpractice cap. So if the doctor cuts off the wrong leg, the most they can be sued for is $500,000 plus the medicals. Yet they're still worried. Why are they worried? Well, because medical malpractice cap is only applicable if they commit malpractice while they're performing their duties as a doctor. But if they go out and have too much bourbon tonight and get in a wreck, or if they get into a bad business deal, and I'm sure a few of us have heard about the doctors getting into bad business deals before, and the bank starts chasing them, they can come after those assets. So I think in particular for the financial advisors out there, when you have an older client that's worried, and not it doesn't have to be old, but again, somebody that's more mature in their wealth building, this whole concept of being able to self-fund a trust and have those assets protected from creditors is going to really resonate, certainly with the physicians that you'll work with. It's something that I think will really appeal. So we have a number of issues with Louisiana trust law that, again, and I can no longer in good conscience tell my clients that, yeah, go the Louisiana trust route, because there's just too many limitations on it. Now, I'm not saying that, every single client needs to go and establish a trust in one of these jurisdictions, but for a lot of our higher net worth clients, a lot of our clients that either want to do a true dynasty trust, or our clients that want to be able to asset protect, or our clients that are worried about being able to shift that beneficial interest, man, this is the way to go. So the next step becomes, well, if we're not going to use a Louisiana trust, then which jurisdiction should we use? And there's a lot of different thoughts out there. I'll tell you that there's about 13 jurisdictions right now, states that actually have uh, self-settled domestic asset protection trust, for example. There's probably about 15 to 20 states at this point that don't have a rule against perpetuities, so that we can actually have these trusts go on forever. I really do like the Delaware trust. I'll tell you that there's probably 4 jurisdictions that really tend to be the best, and frankly, we can set it up in any of these 4 jurisdictions, but Delaware, Nevada, Alaska, and South Dakota. Those in particular tend to be really, they're kind of well known in the upper echelons of the estate planning world as being kind of the best, overall states for this. One of the reasons I kind of like the Delaware, and you got to kind of look at what the client's trying to achieve too, because there's different rules, of course, in each of those states, so that if you have a client in a particular situation, you're going to have to look at what that situation is to try to figure out, like some of the states, for example, from what I understand, if you put assets into the trust and there's been no, lawsuit for divorce, believe it or not, my understanding is that in some of these states, it's even subject, it's protected from divorce proceedings, which is just mind-boggling to me. But apparently that's what the law is in some states. So you got to kind of look at, what the client's trying to achieve. The reason that I like Delaware so much for my business owner clients is because, as most of us know, Delaware has a very, very long and substantial history of in the courts of being very protective and very favorable to business owners against all sorts of threats out there. Delaware was the second state, for example, to actually implement these domestic asset protection trusts. So we have it's probably been 18 years now that this has been in effect, that the clients can actually use these Dapts in Delaware. So that you've got some history there that can really be good. So let's kind of go through Delaware as one of the better. Let's see. There we go. So Delaware actively, encourages enterprise. They're very modern. They don't have a rule against perpetuities. We can shift interest in the trust. One of the things I really like about the Delaware statute too, that's another unique feature, is that under Louisiana law, the trustee is a fiduciary, and all of the fiduciary responsibilities are all bundled together under that trustee. So what does that mean? That means that the trustee has liability to the beneficiaries for all sorts of things. If for distributions, right? If I'm a trustee and I distribute assets to one of the kids, and I knew that kid had a substance abuse problem, and that kid goes and runs over somebody, arguably a plaintiff's personal injury attorney could try to come sue and sue me as the fiduciary, and the beneficiaries could and say, wait a second, you should have never distributed that money out. You knew that when you distributed it out that this kid had a substance abuse problem, and you could get sued. In Louisiana, you have responsibilities for the management of the trust. You have to have a diversified, you're supposed to be diversified in a portfolio. So the investment performance is really bundled up within that one Louisiana trustee. In Delaware, on the other hand, they actually statutorily split out all the different duties. So you can have what's called an administrative trustee, which we're going to get into in a few minutes. You can have a separate person named as the investment trustee, which could mean the investment advisor, right? I mean, you could appoint the investment advisor, and under state statute, Louisiana doesn't have any such thing. That trust and the trustees are bound to use that investment advisor. Sometimes it's actually a financial advisor. Sometimes it's the client themselves, believe it or not. You can actually have what's called a trust protector. And this is, again, by state statute. Most of the times the clients will appoint their attorney as the trust protector, and the trust protector can be given either a very narrow or a very broad ability to change the trust, including, believe it or not, the ability to change the beneficiaries of the trust. And your first thought when I say that should be, holy good Lord, why would I want to give somebody the right to do that? Well, think about it. Again, we set up a trust. We got a client with some young kids. They're in their teens, let's say. And everybody's getting along now. It's an irrevocable trust. We move assets into it, and all of a sudden, 5 years later, the client calls and says, man, my son ran off, and he doesn't talk to me anymore, and he thinks I'm a no good SOB, and he doesn't want anything to do with me, and I'll be damned if I'm going to leave him any of my estate. Well, if you've already put stuff in a trust, it's too late, right? Not if you have a Delaware trust, because you can appoint a trust protector, whether it's an attorney or somebody else, and that person can be given the right to cut back on the number of beneficiaries and literally exclude them, something that we can't do under Louisiana law.
Can you add to them?
Yes. Yeah, you can kind of expand it or contract it. Usually when I'm drafting these now, what I'm doing is I'm saying that the trust protector has the ability to change the beneficiaries as long as the beneficiary class consists typically of the settlor's descendants. That way the trust protector can't go appoint his best friend, to suddenly be a trustee of the trust, that kind of crazy stuff. I'm going to keep pressing this wrong thing. So a lot of really, higher end advisors recognize that Delaware has a long history of being a great situs for trust. They have a substantial body of tax law and asset protection law in Delaware. And they're not, again, a lot of this isn't unique to Delaware. There's other states, but again, for a lot of purposes, we want to find Delaware is a really good jurisdiction to look at. So how do you set up a Delaware trust? Can I just go set up a Delaware trust and just say that I'm setting one up? Well, no, it's got to actually be in compliance with Delaware law. And you have to establish what the legal term would be a nexus. In other words, you have to have some sort of connection to that state that you set it up in. How do we do that? Well, we can have a Delaware trustee. Well, what usually happens when I say that is a client then says, well, wait a second, I'm going to be transferring my business interests to this thing, or some cash or life insurance, whatever. I don't know who this Delaware bank is. I don't want to be dealing with a Delaware bank. Well, remember, under the Delaware trust statute, we can split out the different responsibilities of a trust of a trustee. So as long as we have an administrative trustee that is based in Delaware, then we can actually, we establish nexus. So that gives us our tie-in to the state. I'm a part, I think some of y'all know, of this group called Wealth Council. It's a national organization of kind of higher end estate planning attorneys. And one of the guys that formed Wealth Council is a tax attorney out of New York, Lou Piero, that he and I have started doing a lot of work together. And he set up this thing called Advocates Trust Company, which I've now become affiliated with. Paid like $200 to become a member, basically. And what it allows me to do is to actually set up for my clients to have the Advocates Trust Company serve as the administrative trustee. And literally, they don't have any financial responsibilities. They're not the financial trustee. They're not the trust protector. They don't have any duties of distribution. So because they don't have all those responsibilities, their cost structure is a lot lower than the typical, bank trust department. So if I go to the Whitney or Chase or any of the major banks, typically they're going to tell me that they're going to charge about anywhere from a half a point all the way up to 2 points every year as a management fee. And for a lot of people, they really need that kind of help, under Louisiana law, where a good institutional trustee can really be a good thing for families. But under Delaware law, because that administrative trustee doesn't have all those other responsibilities, that this advocates trust group only charges like a few $1,000s a year, regardless of the value of the assets in there. If the assets are structured properly, I think that it's something like maybe $5,000 a year from what I understand. So so if you move $10 million worth of assets, instead of being charged 1%, and a lot of banks, by the way, don't want to manage business assets and things like that, you kind of have a low fixed fee to kind of get into it. And then the client can then appoint somebody else to make the distribution decisions. So they can appoint their sibling, let's say, they can appoint somebody else to be the financial advisor, appoint somebody else to be the trust protector. And it's a good way to kind of, bifurcate that and be able to get that nexus that we're going to need. So what are some of the, features and benefits? Privacy. So under Delaware laws, we're going to talk about in a few minutes, there's a lot of privacy built in where we're not having to go to court and do accountings. Delaware, the spendthrift provisions are really good. In other words, that this really appeals to almost all of our clients. Even when we're doing wills now, we'll set up these testamentary trusts to go for the longest term allowed under Louisiana law. What that allows us to do is that those assets, if that beneficiary, that kid gets divorced, if that kid gets into a lawsuit, if that kid gets sued for some personal injury action, it's going to be virtually impossible for a creditor to get to it. Delaware also has very strong, spendthrift provisions. There's no rule against perpetuities under Delaware law, so we can have this trust go on forever. We have a client down the bayou right now that he wants to, and he has a testamentary trust right now. And he said, Todd, I really want to set up something that's going to go on for multiple generations for my family. So what we're going to do is we're going to have his will. We're going to set up a Delaware dynasty trust, and we're going to, and his will point to that trust to be the beneficiary when he dies. And when he passes away, the assets are going to go into that trust, and his kids will live off the income with some withdrawal rights of the principal if we need it. And then when they die, those assets aren't going to be in their estate, at least under current federal law. There's been some talk by the Obama administration that they obviously don't like these dynasty trusts because we can go multiple generations and skip taxes. So literally it can save the family, like I've talked about. I mean, we've got some charts. It's hundreds of millions of dollars over 3 or 4 generations. Just think about it. If you got $40 million and you die, and there's a 40%, let's call it 50% to keep it easy. You got 20 million the next generation, and then they live off the interest, and when they die, there's a 50% tax. You got 10 million. Well, you can imagine if instead of getting hit every time, you got growth going on, there's a huge tax savings to the family. And of course, some of the liberals feel like, that needs to be addressed. So Obama's talked about only being able to get the tax benefits for about 90 years. So I explained that to the client. I said, look, right now, this means that there'll be no taxes of any assets you put in here after you die. But understand that, that they could address the tax issue. No matter what, each generation is going to be able to live off the income. So you're going to have this true legacy type trust that'll go on forever. You can delegate investment responsibility through the investment trustee. Taxation of non-resident beneficiaries. So Delaware, this is kind of, I didn't even think that this would be a big issue, but for some of my clients, it really is. Louisiana, as we all know, has an income tax. Delaware does not. If we put assets into a Delaware trust and we invest those assets and they're generating profit, and we keep the profits inside the trust, there is no Delaware tax on it, and I've gotten confirmation from several CPAs now that there is no Louisiana tax on those profits that are retained. So we've got some clients right now that are looking at selling their business, and they realize they're going to get hit with a 23.8% federal capital gains tax when they sell the stock, because you got the new federal rate of 20% and the 3.8% surtax. And then on top of that, you have the Louisiana capital gains tax. Well, what if instead we transfer the assets into the trust in Delaware, and as long as we keep the profit once we sell it inside that trust, we're not paying any Louisiana income taxes on it. So it's a really nice little play there. And remember, if you're controlling the company, we can create Class A voting shares and Class B non-voting shares that we transfer to the trust. You can still take your salary, you're controlling the entity. We've done that with a number of different clients. The private matters, so, basically,
If you put your corporation in there and you wanted to, at some point, you had somebody you wanted to issue stock to, is that still possible?
yeah, so basically what happens there is that, depends on what we're trying to accomplish, right? When we transfer an asset into one of these trusts, we can do one, and there's a decision point that has to come early on before we transfer the assets in. Are we going to do it as a completed gift? In other words, some of our clients want to transfer their assets while they're alive because we get discounts and we save a bunch on estate taxes. And for that kind of situation, what we would do is we would have typically the client maintain the Class A voting shares, and the 99% of the shares that are Class B non-voting, we would transfer some or all of those to the trust. And in that kind of trust, we can't and do not want to have the client be a beneficiary of the trust, because to the extent you're a beneficiary of the trust, then those assets would be includable in your estate. But other clients don't want to make a gift. They just want to do asset protection. When we move assets into this trust, we can structure it either way. So if you're not worried about gifting for whatever reasons, either because you're below the exemptions or you're just not worried about it, we can put assets into a trust. Your kids and you become a permissible beneficiary. You appoint a friendly person to be the distribution trustee who's going to make the distribution trustee is going to decide who gets distributed what and when. If you're having problems, you've been sued, then the distribution trustee is going to say, well, I'm not going to distribute anything to you, because if I distribute it to you, the creditor is going to take it. If everything's free and clear, then they can distribute it back to you. So one of the things we have to do early on is decide, are you going to make a completed taxable gift or not? And then we can base it on that. Now you might say, well, today I don't want to make a gift, so I'm going to put some of my assets into it. And then later you can actually change your mind and say, okay, now I want it to be a completed gift, and there's ways that we can then remove you as a beneficiary of the trust. Now just your kids are the beneficiaries. There's some other things that we do. At that point, it becomes a gift. We file a gift tax return. It's all asset protected from your creditors and the creditors of the children. Did that explain it? Basically, as far as privacies and accountings, generally, we don't have to give notice. That's a big thing for a lot of our clients, right? They say, I don't like the idea of my kids knowing what's in the trust. Well, under Delaware law, we don't have to provide them with annual accountings and notices of what's going on with that. There's no formal court accountings where we have to go to the court. If one is prepared, then the trust just pays for it out of the trust's assets. Spendthrift provisions, I don't know that there's a tremendous advantage in Delaware over Louisiana. Louisiana's actually got some pretty good spendthrift provisions, in my opinion. So what that means is that if one of my kids gets sued and they're the beneficiary of the trust, who can get to it? Well, clearly, let's say that my child is married and the spouse is trying to get to the assets. Understand that if I've gifted an asset, when I gift that asset, it's separate property. However, under Louisiana community property laws, if that property then generates a dividend or interest, that dividend or interest is considered community. So arguably the spouse could get to that half of the interest, but they can't get to the principal. The difference being that if instead of using a trust, I had left the asset to my daughter, let's say, I leave her $100,000, right? Clearly the $100,000 is separate. If that $100,000, she goes and, the trustee or she invests it and gets 5%, then that 5% is community. But the 100's separate. The difference is when we've maintained it in the trust, then the spouse can't claim that it's been commingled. Whereas if I gave it to my daughter, she goes and puts it into their bank account, they pay the house note, then they put salary in it, then they pay some other bill, and they put something else in it. It all gets commingled, and now all of a sudden what was the $100,000 separate for my daughter becomes commingled, becomes community. We can protect that while it's maintained in the trust. It's one of the reasons I always like using trust. There's most of the tax attorneys, frankly, that I've seen in our state, they have their trust terminated at age 35. And about 10 years ago, I stopped doing it. I'm like, why in the world do we want to have these trusts terminate? People get divorced after 35. People get sued after 35. Why not have the trust go on forever? Well, the next logical step was, well, if we're going to do it in Louisiana and go for the longest term allowed by law, but there's a rule against perpetuities, then why don't we go to Delaware where we can go on forever? And the family's wealth now can be protected not just from the kids' creditors and divorces, but the grandkids and the great-grandkids and the great-great-grandkids and on and on and on. And as long as you keep it within that protective wrapper of the trust, much like an insurance policy, it's protected from seizure by creditors. What's the exceptions? In Louisiana, the primary exception is for past due child support. So if my daughter has abandoned my grandchild and she's on the hook to pay some child support, then they can pierce the trust that she's the beneficiary of under Louisiana law to get my grandkid the appropriate amount of child support payments. Is basically the only exception. Most of my clients aren't facing those sorts of issues. It doesn't tend to happen at the higher ends of the economic spectrum. So with all of this stuff, we're going to talk about it in a little bit, but it protects bank accounts. You have to make sure that there's that the client is solvent. So we'll do a solvency affidavit. So what does this not help with? Generally, not just in Delaware, but around the states. Every state has, in Louisiana, it's called something different. It's called a revocatory action. But under most states, it's called a fraudulent conveyance statute. So if I have a judgment against me already and I'm in default and they're coming after me, I can't just go move my assets to default my creditors. It's not going to work under Louisiana or pretty much any other law. And we're going to talk a little bit about that in a bit. So basically, in an asset protection trust, it's basically a trust where there's going to be a spendthrift provision. If it's not a completed gift, then the client is going to be one of the permissible beneficiaries along typically with their children, so that way, because the distribution trustee can decide to distribute some or all of it to any one of the beneficiaries, it serves as the utmost in asset protection, because a creditor can't force the trustee to distribute it to one when the trust provisions say that the trustee has the ability to distribute all to one or some to one and some to another. Because you have that kind of truly discretionary trust, that's the best form of asset protection. Whereas if our trust says you have to distribute all the income out, then you have to distribute all the income out, and once it comes out the trust, it can be seized by anybody, regardless of who's it being distributed to. So, any questions so far? Okay. Some of our clients want to do offshore trusts. Now, I'm sure some of y'all have read that there's been a lot of IRS movement in the last couple of years whereby people went and set up these offshore accounts. Understand that what I'm talking about is something very different from what some of the stuff is that you read. The stuff that you've read about, what they did is that there are certain countries that have bilateral treaties with the United States, or they just have laws that forbid that country under their laws from disclosing information about assets held in that country. So Swiss, you've all heard about the Swiss bank accounts. What those people were doing basically was they were moving assets and having investment accounts and things like that located in these jurisdictions. And it's not just in Sweden. There's a bunch of favorable tax jurisdictions out there that basically don't report that income back to the United States. Well, if you're a U.S. citizen, the tax code's crystal clear. If you're a U.S. citizen, you are taxable on your worldwide income. Well, what they were unfortunately being advised to do was to go park their money in some foreign countries, under their jurisdiction. There's no reporting going back to the IRS. They know that's the game. They're not paying income on the earnings held by those assets. Well, the IRS eventually got them, and at least a lot of them with USB. I saw a lot of that. So when I'm talking about offshore trust, I'm not talking about it as a tax avoidance measure. I'm talking about some of our clients have looked at offshore trust as an asset protection measure. They're paying the taxes on the assets, but you can set up trusts in BVI and a bunch of other jurisdictions. The issue is with a lot of our clients is always try. It's almost like a scale. You want simple and cheap and less effective, we can do that. If you want something that's more effective, then it's going to be a little bit more complex and a little bit more costly. If you want the very most effective thing, then it's going to be really complex and really costly. So, and that's kind of the conversation that I have with the clients is that, hey, look, you want something simple and fairly straightforward, then let's just set up a Louisiana trust, right? We don't have to worry about all this. You have to spend a little bit more money to go get it set up in another state's jurisdictions. It's going to be a little bit more complex. We've got to get a Delaware trustee. It's just going to be a little bit more involved. But we can do it and have better protection, but at a little bit more administrative and financial costs. You want the utmost protection, then yeah, we can go offshore, but I've always told people, Louisiana law is going to get you probably 75% of the way home on asset protection. I think that the Delaware and Nevada trust get you about 95% of the way home. You got to kind of decide whether or not, that 5% is worth now going offshore, and you've got all these other issues, right? You're worried about what happens about the stability of the government, right? I mean, God help anybody that wants to park money in Egypt right now, right? I wouldn't want to have my money over there. So you got to watch once you go off of U.S. shores, some of those sorts of things. But for some clients, it makes sense. So what does a qualified asset protection trust require? Basically, we're going to have to appoint a qualified trustee that has a nexus in that particular state. The trust has to be irrevocable, right? So if the trust is revocable, then what that means is the client can revoke it and put the assets back in their name. Well, from an asset protection strategy, if you have the ability to revoke the trust and get the assets in your name, then it doesn't serve as an asset protection, so it's got to be irrevocable. Now, having said that, for example, in the Louisiana law, we can actually amend, believe it or not, an irrevocable trust. In fact, we're doing one today. Probably done 30 or 40 of them in my life. And typically the judge signs off on it, so it can be done, but generally speaking, it's an irrevocable trust. And we put this as kind of a spendthrift clause in there. It prevents not just creditors, but it also prevents the beneficiary from being able to go out there and say, look, I'm not the trustee, but I'm a beneficiary of a trust and it's got millions of dollars in it. Hey, bank, I want to pledge my trust interest to secure some deal I want to go do. Well, most good spendthrift clauses, whether it's Louisiana or otherwise, are going to prevent the beneficiary from being able to do that. If the trust is set up that the receipt of the income is at the sole discretion of the trustee, then what's going to happen again is we're going to get the Delaware benefit of not having to pay income taxes on that money. And so the settlor is the person that creates the trust. They can retain that right. They can retain the right to receive a certain percentage. There's a bunch of ways we can do it. But remember that whatever I like to do it, the best asset protection is to make it completely discretionary on behalf of whoever you're going to appoint as the distribution trustee. If we put in the trust what we call 5x5 power, which is 5% or $5,000 from the trust, and the creator of the trust says, I'm going to keep that 5% of 5, then that could be seized, obviously. Whereas if we instead make it a purely discretionary trust, then because it's discretionary in the opinion of a outside, whoever you've appointed, an independent distribution trustee, then the whole thing could be kept free from seizure by creditors. What you got back?
How often do you have problems with the trustees not acting in the best interest of the beneficiaries?
It happens. I mean, but we can actually, and it's kind of cool, even though again it's an irrevocable trust. Like in my Louisiana trust, and certainly in our out-of-state trust, we can give the creators, the client, settlors of the trust, the ability to remove and replace trustees with what they call a non-adverse party. So if somebody starts getting out of line, there's a bunch of remedies that you have there. If they're not acting in the beneficiary's best interest, we can actually have them removed and go to court and say, you're not acting in the best interest of the beneficiaries. If they steal from the trust, we can actually put them in jail because they have a legal duty to act in the best interest of the beneficiaries. Or if it's just, I named my best friend and, he wound up sleeping with my wife and now I'm going to go ahead and, I don't talk to him anymore, that kind of thing, or I might thank him, I don't know, but if that kind of thing happens, I can actually put a clause in there where I could remove that trustee and appoint somebody that's more friendly to what we're trying to accomplish. So you do have a good bit of flexibility there. Any other questions so far? We can keep a ascertainable standard. So what that is that we can give the trustee the ability, for example, the most common ascertainable standard is the ability to invade the principal of the trust for the health, education, maintenance, and support of the beneficiary. And that accomplishes really two things. One is that for the client that's worried that my kids may not be able to survive off of just the income, what happens if they have this horrific thing? We need to distribute some of the principal. Well, we can put some provisions in there that allow us, the trustee, to kind of, access the principal if we need it. And secondly, under the tax code, those are some very specific kind of magic words. Health, education, maintenance, and support has a very specific meaning because under the tax code, that is an ascertainable standard. What that basically means is that the assets will not be included in the beneficiary's estate. So in other words, I can set up a trust. I can say my kids and each succeeding generation is going to live off the income, and I give the trustee the right to invade the principal of the trust for their health, education, maintenance, and support, and it won't cause inclusion in my kids' estate when I have that set up that way. Testamentary limited power of appointment, that's an issue that is a little troublesome, but in the sense of it's not recognized under Louisiana law. There are some ways that we've just learned about actually with some of the Medicaid and elder law stuff that we're doing to qualify people for long-term care expenses. We've been able to figure out a way. In other states, they use these limited powers of appointment. We don't have that in Louisiana. We've actually figured out a different way so that when people transfer their assets to a trust to qualify for long-term care expenses, we can still get stepped-up basis when they die, even though the assets have been transferred. It's usually done through a limited power of appointment. Because that's not available in Louisiana, we've figured out a different way to do it. So, and then you can appoint an investment advisor. I've had clients that have really said, I don't care what happens, I want to make sure that so-and-so, my financial advisor, continues to be the financial advisor for this trust. Or I've got some clients that what they'll do is they'll transfer their business interests, and by being the investment advisor, that means that they have control over the company itself because they're managing that investment for the trust. So that investment issue is not just about appointing a typical, RIA or CFP to serve in that capacity. It can even be the client, believe it or not. Perpetuities period, we've kind of covered that. So basically, real property, which is real estate, can be held for 110 years, but personal property can be held in trust forever. So what do we do with our clients that have real estate? We put it in an LLC. Put it in an LLC, it's now personal property, and we can keep it all forever in that trust. And asset protected as long as it's in the trust. Pass wealth to multiple generations without incurring the federal estate tax. Investment flexibility, so that's a pretty cool point too, is that you need not be diversified. So arguably, I've got a client right now that I personally hate serving as trustee because I think it's a no-win situation. But I have one client that I really like a lot. He asked me and his brother and his wife's brother to be co-trustees of a trust. Arguably, one of the risks that I run, frankly, is that let's say that my client winds up running the businesses into the ground, which I don't think he would ever do, but let's say he did. Arguably, the beneficiaries, the kids, could come against me and the two brothers and say, you know what? You had a duty as a fiduciary to have a diversified portfolio, and instead, all you have in this trust is these Class B non-voting, rights to these companies, and you messed up. You should have had some stocks and bonds and money markets, and So arguably, you run into some issues. Whereas under Delaware law, there is no duty to be diversified like that. It can hold a single asset. And you can separate, each one of those people, so you have the administrative trustee, the trust protector, the distribution trustee, the investment trustee, all those people can be made either a fiduciary or not. In my opinion, I'm kind of leaning towards everybody should be a fiduciary, right? We should all, whether you're the trust protector or I think you should have a duty to the beneficiaries to always act in their best interest, There's some technical reasons why every once in a while you won't, but I won't get into the weeds too much with that.
Will you name those different people again?
So under the Delaware statute, there's an administrative trustee who's usually how we establish nexus. So that's going to be, for example, the advocate's trust company, but the client can pick whoever they want, but they have to, you got to leave, Marshall. Okay. But they have to have a connection to the state where you're setting it up. So if I want to set up a trust in Nevada, I got to have some connection with Nevada. So some trustee, one of those people are going to have to serve there. So in Delaware, it's the administrative trustee is usually our nexus. Then from there, we can appoint a investment trustee that's going to be the person, either the financial advisor or the client, that's going to actually manage the assets. Then on top of that, you have a distribution trustee. That's the person who decides when the people will receive money out of the trust that are beneficiaries of the trust. It's usually going to be a friend or a family member of the client. And then you have a trust protector who can be the attorney or can be somebody else, and that person can be given a very broad or very narrow amount of duties and responsibilities under the trust.
Okay. Could you expand on the trust protector a little bit?
Mm-hmm. Trust protector is kind of a newer theory under general trust law that's spreading across the United States. And I'm not sure if you have any insight on that. What do you think? Probably about 5 to 10 maybe states now have trust protector.
Right, and I've seen it in Louisiana documents.
Yeah.
But it's more of an ability to change administrative provisions of the document.
Right. So, and it's not codified.
And it's not codified.
So, in other words, what Cheryl's kind of alluding to here is that I can go create a trust and put a lot of things in it that aren't necessarily, provided for under Louisiana law. Now, whether they would hold up or not, who knows? So, I had clients, I'll never forget this, years ago, that he had a financial advisor and he said, you know what? I don't trust my children's mother, his ex-wife. And he said, I'm worried that she's going to try to, browbeat the trustee. I want to make it real clear. I want to in the document that should I die, these assets are going to be financially managed by this financial advisor. And I told the client, I said, look, I can put that in there, but there's nothing under Louisiana law that says that that's going to be binding. Maybe, it may not be, but there's nothing there. Well, similarly, Cheryl's saying you can do it under Louisiana law, but who knows whether it's going to be upheld. And sure enough, when that particular client died, the kids hired an attorney and they wound up trying to argue, we don't want that financial advisor. And they said, there's no provisions under Louisiana law that say you can do it. And of course, our response was, there's no provisions under Louisiana law that say we can't. And in fact, shouldn't we always be trying to carry out the testator's intent? So, the good thing is that all the stuff that we're talking about under Delaware law, it's all codified. It's all part of the law. It's all been part of the law. So basically, in those 5 to 10 states that have trust protectors, they can be given, again, the ability to change the terms of the trust so that it more properly effectuates what the client's intent is. So whether it be the ability to change the administrative trustee, so maybe somebody comes along that's better or cheaper, we can give them that right.
Does Wisconsin have that provision?
I believe they do. I believe Wisconsin does, actually. I haven't followed the trust protector stuff as closely as I have the domestic asset protection. On the Dapt side, I know Wisconsin has that, that they're one in Wyoming as well. But again, I'm a part of so many different national things, and what I keep seeing over and over again, you got this guy Steve Oceans out of Nevada, and he says Nevada's the best jurisdiction. Well, he's an attorney in Nevada, so he financially benefits from setting them up in Nevada. And Nevada's got some good provisions, but they don't have the long history that Delaware. You always hear Delaware. Alaska was going on for a while, but then a recent court ruling in Alaska brought into question whether or not that's a really good jurisdiction any longer, actually. So that could be, although I think it was a fact-intensive case, but. Anyway, so it's just a matter of kind of looking at each of them and depending upon what the client's objectives are, kind of making a decision. Sure. Court of Chancery has been around, obviously, for hundreds of years now. So you got lots of legal precedent with all this kind of stuff that if there is any problems, we can go there. By the way, because it's a Delaware trust, if some creditor tries to get to this and they try to go after one of the beneficiaries, one of your kids, they got to go to Delaware. And let me tell you, most attorneys are, the more roadblocks you put up in front of them, especially personal injury attorneys, the more roadblocks you put up, the less likely it is that they're even going to try. Like, oh man, I got to go up to Delaware. I'm not licensed in Delaware. Now I got to go get co-counsel and have to split the fee with them. That kind of stuff happens, and it's another, way to try to defend the client's assets. The hybrid domestic asset protection trust is just basically a third-party trust that can turn into a self-settled trust. I'm not going to get too much into that. That's one of the Oceans concepts. This is an attorney out of Nevada. For those of y'all that know Steve Oceans, I think he's a really bright attorney. He's a little bit what I would call bleeding edge, not just cutting edge. Some of his ideas I know don't work under Louisiana law, and I think if the IRS audits some of them, I think he could have some issues, but there's other stuff that I think is really sound planning that he does. He's kind of become one of those guys nationally that he's very much a self-promoter, but anyway, that was one of his ideas. So right now we have 14 states that have these domestic asset protection trusts. You got to watch these pre-existing creditors. So depending upon the state, there's these fraudulent conveyance statutes. Again, under Louisiana law, it's called a revocatory action. We always spend some time as we go through this process kind of talking with the client. Do you have any known creditors? We actually have them sign an affidavit attesting to the fact that they don't have these lawsuits against them, so that we know that it's a solvency affidavit, basically. Increasing the odds. So no Dapt has ever been pierced in 15 years. So in other words, in 15 years, there hasn't been one where these laws were somehow overturned and somebody was able to pierce this. So remember, the Dapt specifically is a self-settled trust. I put my assets into a trust, and for the 15 years that this has been going on, we haven't had one pierced yet. Now, say that there's that one in Alaska that right now there's a judgment against the guy. Why did that happen? Without getting into too much detail on it, that whole thing was messed up. He actually had a judgment already against him. There were all these other issues that they didn't really structure it properly. And I still think he has a shot at winning on appeal. So there were some problems with that case. It really wasn't done properly. But generally speaking, that they haven't had it pierced for 15 years now. So that's really the presentation. I know it's a lot of detail, guys. I frankly don't know of too many other law firms. I haven't really heard anybody talking about this stuff. But again, for so many of our clients, I know Chase at one point had done a presentation a couple of years ago. I've heard that one of the other big law firms, I don't know if it was Adams and Reese maybe, had done a presentation on them. But this is something that we're really kind of excited to start being able to bring to our clients. I'd read about these for years, but I really didn't have the opportunity to really learn about them and be able to actually set them up for our clients until we got involved with Wealth Counsel. And the cool part about that is that we have attorneys throughout the United States now. So if I want to go set up an Alaska, Delaware, domestic asset protection trust, we have attorneys in Alaska that can co-counsel with us and make sure that the client's interests are protected. We have attorneys in Wealth Counsel that have been doing this stuff for literally years and years, so they have a lot of experience. So that's what we're typically doing, at least at the early stages, is just kind of co-counseling with them. It doesn't cost the client any more money. We just simply, we make sure that attorney gets paid for their time. And we're doing it really right now. We've got a couple of different clients that are doing this from the domestic asset protection side. We got that one client that it's not really domestic asset protection because he's not funding it now. He's going to have it in his will, where his will is going to point to that trust so he can get the dynastic features. And then we have another client that, again, is looking to sell their business before the end of the year. He's thinking he's going to get about $8 million, net sale proceeds. And he's like, man, if I can beat the state, capital gains, income tax issues by moving it in there, I really want to talk to you about it. And he's a 1/4 partner, so so we're going to talk to the other partners because they each might want to do this and be able to beat some of the state taxes as well. So there's really a bunch of different pieces to it, that depend upon what the client's objectives are that we can try to accomplish there. So.
Well, but then you mentioned the $8 million, and I wondered if there's a rule of thumb. If you've got a sort of a rule of thumb in your mind about either net worth or special circumstance when this might be appropriate.
So if we're not doing a completed gift, You're usually looking at somewhere between 12 and 18,000, let's say, to get this whole thing set up. And then again, there's going to be an ongoing administrative fee by the trustee. Like I said, I think it's like 3 to 5,000, somewhere up in there, regardless of the size of the assets. So you got to do a cost benefit analysis and decide, are you just doing it for income tax purposes, and what kind of income tax savings can we achieve with this thing? It's all state level, not federal, obviously. And then you got to weigh everything else. Well, what happens if I got sued? Well, I've had clients that have been sued and lost everything, and sometimes the insurance coverage isn't enough, or there's a ceiling on that coverage, and the event was so bad that they lost everything. Well, this is the kind of thing that we can protect their assets, but you got to do it proactively. You can't wait till the lawsuit's been filed. Now, arguably, you could, as long as we didn't have a final judgment, but that's the kind of thing you don't want to take the chance with, right? I mean, you want to kind of do this well in advance, and it's something now that as I meet with my clients and I'm talking to them about business planning, or business succession planning, or tax and estate planning, we're starting to talk to them now about these kind of things, because it's really, other than the cost to get the thing set up, why wouldn't you? Why wouldn't you put up those roadblocks? Because again, over and over, I keep hearing from my clients, I've managed to build up this wealth, but now what I'm really worried about is protecting them. I'm worried about my creditors. I'm worried about the kids that, my kids, and who they're going to marry down the road, or maybe I already don't like the guy that my daughter's married to. That kind of comments I hear over and over again. And to me, this just seems like such a great way to, to accomplish, and we can accomplish several things, right? So again, if we put your own assets into while you're alive, what has that done? Well, it's now domestic asset protected. If you want it to be a dynastic trust, it can be, right? And the assets that we put in there are going to save on the state income tax, so it can actually check off a bunch of boxes as we do it. Now, if you make a completed gift to the trust, then you're talking about a whole bigger, thing, because now it's a lot more expensive. Because if I have a client that wants to make, it's not just about asset protection, they want to do some estate and gift tax planning. That means it has to be a completed gift, and in order to be a completed gift, we got to get valuations done. We got to set up all the corporate structures with the voting and non-voting shares. We got to decide whether it's going to be a grantor trust. We got on and on. So the cost when it's a completed gift wound up going up exponentially, actually, and we faced all this, as a lot of y'all were aware of, last year, right? Because there was this whole threat that we're going to go back down to $1 million estate and gift tax exemption, and we had more clients moving wealth than probably in all the years of my 20 years of practice combined. We had just a substantial number of clients because they were so worried, and rightfully so. I mean, I honestly, I didn't think it was going to go back down to $1 million, but I really thought there was a good chance that it would be like $3.5 million, that kind of mid-range. And I think myself and a lot of the estate planning community around the country was kind of surprised that they were able to get it back up to it's now $5,250,000 per spouse. The question becomes, well, do we have any clients with buyer's remorse? And the answer to that's actually no. I haven't had a single client come back to me and say, Todd, I wish I wouldn't have spent that time and money doing this. Why? Well, because if they did this, they probably are going to have an estate tax anyway, regardless of what they do with the exemption, because their wealth's so much. And now it's asset protected, maybe not as much as, if we set up a Louisiana trust, maybe not as much as in Delaware, but it's protected from their creditors and their kids' creditors, and we remove all the growth from estate taxation. But when we do that, man, it's a lot more involved. So if I got a boat company, I got to get all my boats surveyed. Then once we get the surveys and the equipment surveyed, we then have to go get the business itself appraised. Then we got to set up all the corporate documents to make sure we got the voting and non-voting shares and all that kind of stuff. I mean, it gets kind of costly. So just know there's a bigger setup when it's actually a gift, and a true gift, not just a asset protection. Because in these Dapts, it's not a gift. You're putting it into a trust, and you're a permissible beneficiary. So it's not a completed gift.
And the completed gift is where the 3-year rule comes into?
You talking about with life insurance? The string prevent. So life insurance is probably what you're thinking of. I'm assuming that's the most common string provision that happens. Yeah, there's other ways that we get around that though. So if I have a client that has a life insurance policy, for those of y'all that aren't familiar with this, if you just donate, you gift your policy into a trust, and you happen to die within 3 years, then the IRS, through their string provisions, basically say you did that in contemplation of death, and as a result, that the death benefit of that life insurance is brought back into your estate from an estate tax standpoint. We get around that, quite frankly, whether we use a Louisiana or a different trust, by setting up a grantor trust. We have the client, we value the policy and get the interpolated terminal reserve or whatever, put the cash into the trust as a donation of cash, and then we have the trustee buy the policy from the client, and that's how we get around that 3-year look-back rule. Because it's a grantor trust, there's no transfer for value problems, and because it's a sale rather than a donation, we avoid that 3-year look-back. But with these kind of things for the domestic asset protection side, you don't really, there is no 3-year rule. They're basically looking at, was the primary purpose for you transferring these assets to defraud a known creditor? That's what they're basically looking at. And obviously there's, I think, a black, a white, and a gray. In other words, right now, I don't know of any lawsuits against me. I could certainly transfer an asset in. The black would be, oh man, I got a judgment against me, and they're trying to collect tomorrow. Too late. And then there's that whole gray area, right? And I have a client right now that 3 years ago did a completed gift. He had 40 different entities. I mean, it was a huge project. And we transferred 40 different companies out of his estate into a trust, asset protected, all that kind of stuff. He had this one little business deal out of state that, unfortunately, clients really should talk to attorneys before they do things. He was a 3% owner, but he was jointly and severally liable for the entire debt, which was about $5 to $10 million of debt. And he's been all nervous, he's saying, well, Todd, what's going to happen? And I'm like, I don't know. You knew there was a creditor, right? So he's in that gray area. It's not that when he did this, it's not like he knew that there was nobody out there. Yet there was no judgment against him, and in fact, he feels and felt and still feels that this creditor really they swapped some paper on him, and there's some crazy stuff that happened, and he really thinks that he's not on the hook for it. And I actually think he's right, but will the creditor be able to pierce his trust through a revocatory action? That, or in this case, it's out of Alabama, so it's a fraudulent conveyance. And I told him, I said, client, I don't think so. You didn't come to me to try to defraud this creditor. You came to me because I'm a tax attorney. You came to me because you had a tens of millions of dollar estate tax problem, and we solved that problem. And it had nothing to, yeah, I knew because you told me about this potential creditor out there, but you weren't doing this to try to defraud. You're worth a lot more than even if you were on the hook for the whole thing. And I think we have a good defense. And I said, you know what, at a minimum, you're still ahead of the game because you've transferred it to a trust, whereas if you hadn't transferred it, now they could clearly take it. So I can't guarantee you what the result's going to ultimately be. He's now gotten a final judgment, actually, against him, at least at the trial court. He's going to appeal it. And he called me a week ago, and I'm like, I don't know what they're going to do, but I know they're going to try to say that you fraudulently conveyed it. And I'll get up on the stand and I'll say, no, that's not why you did it. And I have document records about why you were doing it,
So it's safe to assume the other 97% of his owners don't have any money? Okay.
Some doctors, believe it or not. No. I wish I could get all of my doctors in a room and just talk to some business sense and tell them, before you do anything business-wise,
Wouldn't be good for the profession to do that.
Yeah, it would lead to less planning for the financial advisors and attorneys, I guess. So, any other questions?
Could you define self-settled trust a little better?
Yeah, so the whole concept of any domestic asset protection trust is that, and this is something that really didn't become available to any state up until about 15 years ago. The general theory under trust law has always been that if somebody else puts assets into the trust, what we would call a third party settled trust, so if my parents die and they leave, assets to me in a trust, the assets didn't come from me, it came from a third party. That is a third-party settled trust, and generally, with a third-party funded trust, as the beneficiary, those assets go in, and creditors can't get to me, as long as it stays in the trust. The other option is not a third-party settled trust. It is a self-funded trust. I create a trust. I put my own assets into that trust. Well, historically, if I put my own assets into a trust, they weren't protected from seizure by creditors. And under Louisiana law, that is still the case. However, many different states, including Delaware and Alaska, these domestic asset protection trusts, have now enacted statutes that allow you to self-settle the trust. I'm taking my assets, not your assets, my assets, putting them into a trust, and even though they were my assets, and even though I'm a permissible beneficiary under that trust, they're statutorily protected from seizure if I go out and drink too much bourbon tonight and run over somebody, or if I get into a bad business deal and the bank's chasing me, as long as I wasn't doing it to defraud a known creditor.
So if you inherit assets of a trust.
That is now your asset.
And it wasn't.
Wait, when you inherited it, did it go into a trust or did you inherit it individually?
If you inherit individually.
Okay, so now it's your asset.
So it wasn't a trust, but the parents both passed.
Mhm.
Then it's no longer in a trust, no longer protected from creditors. Then if you create a trust at that point, it's not a perpetuation of the first trust. It's now a
Correct.
self-settled trust.
That's correct. And if you do that under Louisiana law, your creditors can still get to it. If you do that under Delaware, Nevada, Alaska law, and you don't have any known creditors, you're golden. They're not going to be able to get to it.
Thank you.
It's protected. Questions? Thank y'all so much for your time. I hope y'all got some good value out of today. Get a chance. Thank you. Please make sure that y'all get your CE credit for those